Are you constantly surprised by your tax bill every April? Do you constantly find yourself scrambling, searching for receipts, and wondering if you could have saved more throughout the year? Hi, I'm Toyin, a chartered professional accountant, money coach, and financial planner with an MBA. I've spent thousands of hours helping people optimize their money and business finances. Today, I'm going to walk you through what tax planning really is and why it is crucial for you to start now, not at tax filing season when it is too late. Tax planning isn't just about filing your taxes correctly. It is a proactive year-round strategy that helps you legally minimize your tax burden while maximizing your financial goals. Think of it as the difference between reacting to your financial situation and strategically directing it. When most Canadians think about taxes, they think about the frantic rush in March and April to gather documents and file your return with the Canada Revenue Agency. But that's tax preparation, not tax planning. Tax planning involves understanding how different income sources are taxed, timing your incomes and deductions strategically, making informed decisions about investments, retirement contributions, and business expenses, taking advantage of credits and deductions for which you qualify, structuring your affairs to minimize tax liability over multiple years. Let me share something important. For every decision you make without considering the tax implications, you're potentially leaving money on the table. Here's a simple example. Contributing to your RRSP on the 1st of March every year might feel responsible, but if you had instead set up monthly contributions throughout the previous year, you could have benefited from dollar cost averaging in your investments, reduced your tax withholding throughout the year, improving your cash flow, and avoided the last-minute scramble and stress. Or consider business owners who purchase equipment in April when they realize they owe taxes instead of making strategic purchases in December when they could influence the current year. These seemingly small timing differences can cost thousands of dollars. The simple biggest shift I want you to make today is to stop seeing taxes as an annual event and start seeing them as part of your ongoing financial strategy. When you become proactive with tax planning, three major things will happen. One, you'll gain control over your financial future. Rather than be surprised by your tax bill, you can predict it and take steps to manage it. Two, you make better informed decisions throughout the year. Every financial choice, from changing jobs to selling investments to starting a side business, has tax implications. Understanding this before you act puts you in the driver's seat. Three, you save more money. Proper tax planning can legally reduce what you owe the Canada Revenue Agency, keeping more money in your pocket for the things you love. The best time to start tax planning is January 1st. The second best time is today. If you're watching this video in January, fantastic. You have the entire year ahead to implement the strategies that will benefit you when tax filing season arrives. If it's July, don't wait until January to start. There are 6 months of potential tax savings you could start implementing right now. And if it's December, there are still last-minute strategies that can make a significant difference. Here are 5 actionable steps to begin your tax planning journey. 1. Schedule quarterly tax check-ins. Mark your calendar for January, April, July, and October to review your tax situation and make adjustments. 2. Organize your financial documents systematically. Create digital or physical folders for income statements, receipts, and investment statements as soon as they arrive. 3. Understand your income sources and their tax treatment. Different types of income, employment income, self-employment income, investment income are taxed differently in Canada. 4. Maximize your registered accounts strategically. Decide how to allocate contributions between your TFSA and RRSPs based on your current and future tax brackets. 5. Consider working with a tax professional. Tax rules change frequently, and a professional can help you navigate them to your advantage. Here are common tax planning mistakes to avoid. Even well-intentioned Canadians make some of these common mistakes. 1. Focusing only on deductions instead of credits. Most credits provide dollar-for-dollar tax reduction. 2. Failing to income split with family members when appropriate. 3. Ignoring the tax implications of investment decisions. 4. Missing provincial tax credits and programs. 5. Waiting until tax season to think about tax strategy. Your tax planning needs will evolve as your life changes. If you're a young professional, focus on building good habits, understanding basic deductions, and setting up efficient saving systems. If you're a mid-career individual, consider income splitting opportunities, optimize retirement contributions, and manage investment income strategically. If you're near retirement, focus on withdrawal strategies to minimize tax, timing when to take CPA and OAS, and estate planning considerations. Tax planning isn't just for the wealthy. It's for anyone who wants to be intentional about building financial security. By shifting from reactive tax preparation to proactive tax planning, you take control of your financial future and keep more of what you earn. Remember, when tax filing season arrives, it is already too late to implement most of these strategies. Start your tax planning today. For more help with strategic tax decision, check out my video TFSA versus RRSP, where I break down how to choose between these two important investment vehicles to optimize your financial situation. See you in the next video.